Trump administration insists that America's tariffs are inflicting serious damage on China's economy. Are they right? And if so, why hasn't China yielded yet and pressed for a deal? This is Dan Joseph of the Global Dashboard. These might be the most important questions in the trade war at this point, and in this video, we'll answer them. First, there's no doubt that China's economy is in trouble, slowing down significantly. Official data shows that in category after category, China is hitting lows not seen in decades. Overall GDP growth, industrial production, auto sales, to name just a few examples. Unfortunately for China, it's likely worse than that. China has long been accused of overstating its growth, and scrutiny and doubt has only increased as growth slowed. Via a variety of methods, from satellite images of industrial parks to energy consumption and tax collections, a diverse set of economists and analysts have estimated that China is overstating growth by 1 to 3%, not exactly a small amount. Here's the kicker. You can't grow at 10% forever, so China had to slow down eventually. But these are the growth rates that Taiwan and South Korea maintained for a decade after they had reached roughly the same level of development as China right now. That means China is at risk of falling behind the path of other developed countries, and that is a sign that a very serious problem has developed. Is the trade war the problem? Well, we actually have to go back a bit further to the roots of China's growth. As I always like to say, China hasn't experienced tremendous growth because communism suddenly worked. China started reforming its economy, moving toward the free market and private enterprise in about 1980. Reform wasn't a sprint for China because, frankly, speed can lead to instability. Slow and steady, a gradual, step-by-step reform program. That was China's approach. And that is how China went from an economy that was 100% government controlled in 1980 to one that is now roughly 60 to 70% private enterprise, 30 to 40% state directed. The problem is, maybe about 10 or even 15 years ago, that gradual pace of reform slowed down so much as almost completely stopped. And that has led to yet another problem. Instead of reform for the last decade or so, China has relied on debt for growth. So much so that debt to GDP has skyrocketed from a fairly low 120% in 2008 to a dangerously high 300% in 2019. Now, to put that in perspective, when Taiwan and South Korea were at roughly the same stage of development, their debt to GDP ratios was less than half of China's. These trends, the slowing of reform, accumulation of debt, slowing of overall growth, all started before the tariffs. So what have the tariffs done? Well, they've definitely led to a decrease in trade between the US and China, no doubt about it. But they've had less of an impact on China's overall trade. Companies have certainly pulled out of China, moving factories or finding suppliers in places like Vietnam or Mexico. But to a certain extent, that was already happening before the tariffs due to rising costs in China. And there are indications that overall investment into China hasn't exactly plummeted. So what does it all mean? Well, it's not that the tariffs aren't having an impact. They are. And as more tariffs are applied and higher tariffs, the impact will grow. And we should also say the impact will grow in the US as well. But regardless, even with higher tariffs, tariffs won't be China's biggest problem, not even close. Debt is hands down China's biggest problem, economic or otherwise. So how does all of this impact the trade war? On the one hand, you might think that tariffs could be the straw that breaks the camel's back, the extra burden that China just can't bear because of all the other problems. Maybe. But I think there is an even more likely scenario. The fact is, the US is demanding exactly what China needs: more reform, more liberalization, more free and open markets. If all that debt and slower growth hasn't already motivated Beijing to accelerate reform again, maybe nothing will. Maybe the tariffs won't make a bit of difference. Maybe the anti-reformers in China have too firm a grip at this point. And there's one other point to consider. Owing to its unique history, its 200 years of decline and national humiliation at the hands of foreign powers, China has an ultra-strong form of nationalism, which I think helps explain why China seems to view this entire trade conflict as more of a political confrontation than an economic one. A conflict where resisting foreign pressure is more important than enduring a little economic pain. If you consider these factors, well, this trade war might drag on for a while. Maybe in a few years, we'll be less worried about trade and more concerned that US companies, which have annual sales in China of about $450 billion, aren't profitable or growing in China anymore. That might impact the US economy more than anything else. This is Dan Joseph with the Global Dashboard. Thanks for watching.